Good morning, everyone. I hope all of you are enjoying being in Bangalore. I'm Rajan Anandan, and it's my absolute honor to be hosting Sanjeev Bikhchandani in a fireside chat at EngageMint. I know all of you are going to have an absolutely fantastic day at EngageMint. It's sorry that both of us can't join you in person, but hopefully us joining you virtually will help you get off to a good start to the day. All right. So all of you know, I mean, unless you've been living under a rock in India, you know who Sanjeev Bikhchandani is. But I do know there are a few of you who are visiting from outside of India, both from GCC as well as some of you from Southeast Asia. So let me start by introducing Sanjeev Bikhchandani. Sanjeev is the founder of InfoEdge. Sanjeev started the company, quite some time ago, a few decades ago, but has done much more than InfoEdge. But just on InfoEdge, for those of you that don't know, it is without question India's most successful consumer internet company. I say that because it's actually number one, very profitable. Number two, continues to grow. Number three, has market leading positions, and most importantly, actually has extraordinary sort of governance and profitability and so on and so forth. So Sanjeev started the company, grew the company to be very, very successful, took the company public. We'll talk a little bit more about that. And today has many brands, including Naukri, which is the leading jobs platform, 99 Acres, Jeevan Sathi, and many others. But actually, InfoEdge is a lot, and Sanjeev a lot more than just that company, right? As many of you know, Sanjeev has led many investments for on behalf of InfoEdge, and including companies like Zomato, Policy Bazaar, and many more. InfoEdge Ventures today is one of the most active venture teams in the country, and for all the amazing work that Sanjeev has done. He's a Padma Shri Awardee. He's also actually last year, Sanjeev was the Midas Touch Investor of the Year, which is absolutely fantastic. But I think most importantly, Sanjeev's been very helpful to founders, and is always available and always there to help founders sort of build amazing companies. So Sanjeev, thank you for everything that you've done. I haven't touched on the many other things, like you're the co-founder of Ashoka University and so many other things, but thank you for everything that you're doing, Sanjeev.
Thanks for inviting me, Rajan, and thanks for those words.
Absolutely.
Somewhat exaggerated, but I'll take it.
No, absolutely. So Sanjeev, the topic for today's chat is building companies that last. So that's the topic we'll focus on. Now, I'm going to start with this. Look, the reality is most companies don't last. We're all in the startup ecosystem. As we know, most startups fail. And even companies that are actually very successful some period of time, after 10, 15, 20 years, they sort of fade away into oblivion, right? We can all think of, brands that, especially those of you that have been around for a few decades, can think of the brands that you saw maybe 20 years ago. Very few of those brands are around today. So the reality is actually building to last is very, very difficult. And at Sequoia, we have this term called, build enduring companies. There are very few enduring companies in the world. So I wanted to start with this, Sanjeev, and you've clearly, built InfoEdge into an enduring company, and we hope that it'll be enduring for many more decades. And you've also been a part of so many other companies' journeys, whether it, Zomato, whether it's Policy Bazaar, and many others. And you've also seen, companies that you've invested in that, have not worked for many other reasons. So Sanjeev, maybe start with this. What does it take to build an enduring company?
So look, I don't have a formula. I don't have a a list of things, but a few things. So number one, companies that last a long time, right, and remain eminent and dominant or market leading, are usually the result of a lifetime's effort of at least a few people. So if you look at Microsoft, Bill Gates spent a lifetime there, along with a number of other people from the start. Look at Google, the founders are still there. They launched in 98. Look at Facebook, 2015, it's 17 years, the founders are still there, right? You look at, let's say, General Motors, which isn't so eminent now or dominant as it used to be. But for the longest time, it was a lifetime effort for Alfred P. Sloan. So the first thing about building to last is you got to commit yourself that I will be here, right? If you don't last, how can the company last? So first thing is the commitment of a few key people. The second is you're doing something important and relevant that the customer needs. So, and are you customer focused? Do you continue to be customer focused? And as customers' needs change, as competition comes in, are you adapting and improving? right? Now, as an individual or 2-3 individuals at the founding team, you cannot build a company that lasts many decades unless you have a whole bunch of other people around you who are working with you, same goal, same objective, same vision, talented people who are empowered. And then next level and future talent. So I think at the heart of it really is the talent pipeline, and the empowerment of talent, right? So if you fail to keep on getting more and more talent and better talent, you will fail to adapt, right? I think as entrepreneurs, we are poor delegators by and large, and so was I. Because, we are entrepreneurs. We want to drive it ourselves. We know how to do it. We are right. We know it. And my way or the highway. That's a knee-jerk sort of de facto sort of thing for many, many entrepreneurs. And, we launched Naukri in 1989-90. And for the first 10 years, we drifted and did a whole bunch of small things, including Naukri, which was a small thing initially. And so I was running it like a proprietorship, right? And when we raised money, we got in talented people laterally. And you can't get in talent and not empower them because they won't stay, right? Especially in a small company. And I wasn't a natural delegator because I had run it for 10 years like a proprietorship. Okay. So it took me 2 years to learn to delegate, but essentially, A, I was willing to delegate in my head. In practice, it was harder. And B, the folks we got on board demanded it. Otherwise, they want to leave. So I gave some, they grabbed more, and so on. So, but if you are able to solve the talent puzzle and you're able to solve the customer puzzle, right, you have a good foundation of building something that will last so long as you last. So you stay for a long time, right? Yeah. There are 2-3 things. There are 2-3 foundations. Of course, there are many, many more things that go into, look, for example, I'll give you a little growth hack, right? So I had bootstrapped the company for 3 years. We raised venture capital. About a couple of months before raising venture capital, while diligence was on, Hitesh joined. And he joined without a mandate. I said, you come, we'll figure out what you'll do. There was no role.
Right.
After spending 2 weeks in the company, which is running out of my house actually, so after spending 2 weeks in the company, he said, listen, you have nobody looking after sales and marketing. You're selling through direct mail. Is it okay if I look after sales and marketing? I said, sure, pick your job. And he suddenly began to look after sales and marketing, because that's what he wanted to do after joining. Right. And he had no marketing experience. He had no sales experience. He had been regional commercial manager of Hindustan Lever Ice Creams.
Right.
He was not a sales guy. He was not a marketing guy. He said, I want to do sales. I said, okay, choose your job. Right. Now, he looked at sales and marketing. And within 3 weeks, he came back to me and said, listen, you're selling by direct mail. Shall we do an experiment? Why don't we hire 4 salespeople? Right? Why don't we hire 4 salespeople who will go out in the field and sell and not just rely on direct mail? And I said, sure thing. We've got this money jostling around in the bank. We'd raised, principally some of 7.3 crores from ICICI Venture. Right? And I said, yeah, sure. Hire 4 salespeople. So he hired 4 salespeople as an experiment. And they went out in the market to HR managers, trying to sell them annual subscriptions on Naukri at 6,000 rupees a piece. Right? And we discovered that within about 3 to 6 months, each salesperson was generating about 50,000 rupees of revenue headed north, right? Every month. Now, the variable cost was only the sales incentive, which is about 7,000 rupees. So there's a 43,000 rupees gross margin. The average salesperson's cost, total cost, salary, conveyance, mobile phone bill, depreciation on the desktop or laptop, office rent, air conditioning, all allocated, fully loaded, was 22,000 rupees a month. This is in the year 2000. So in a sense, we were making a 21,000 rupee profit per salesperson, right? Now, we said, this is cool. And this is head north because, each month he's selling more and more. right? If you're selling 8 subscriptions a month, it's 48,000 rupees, and you're selling 8.5, right? The average person. So that was 50,000 rupees. So we say, hey, this is cool. So we had discovered our way to scale profitably, right? We had found what we now term, and this is our internal jargon, a repeatable profitable unit.
So repeatable profitable unit. That's a very interesting idea.
So we said, look, just keep adding. Our repeatable profitable unit is our sales guy. Keep adding more and more salespeople till the last salesperson does not, break even on his or her own cost, right? And we were finding that salespeople are getting to break even in 3 months and profit in, good profit in 6 months. So they're paying for themselves. Gestation period only 3 months, right? We kept on adding salespeople. And within 2 years, we had 240 salespeople across the country in 11 offices, 11 cities. And suddenly from a 35 lakh rupee turnover per annum, 36 lakh rupees, which is what we were in the year prior to raising venture capital, within 2 years, we hit 10 crores. And we were, so we raised capital in April 2000. So 99-2000 financial year, we had done a 36 lakh rupee turnover with a 2 lakh rupee profit, 1 lakh 80,000 rupee profit, because I wasn't taking a salary, right? 3 years after that, we did 10 crores with 80 lakh rupee profit. So 35 times, 30 times turnover, and a big jump in profit. And I was taking a salary, right? Now, the truth is that this scale would not have happened if Hitesh had not come on board and come out with the idea,
right?
That experiment. So the more and better talent you get, chances are you will scale. If you scale profitably, see, I'll tell you one other thing of long lasting, one key thing, you got to be profitable. If you're profitable, you will last, right? If each time, every 6 months, 9 months, 12 months, 18 months, you are depending on external infusion of capital to survive, it's not a model that lasts beyond a few years, maybe 7, 8, 10 years. Because sooner or later, there will be this whole thing of, okay, now I'm not getting more money from outside. It's harder. The market has turned, as the market might well turn next 2 years with the Fed raising interest rates. So,
by the way, the market has turned, Sanjeev, we'll talk about that already. I mean, the public markets have turned clearly, as you know. And even in the private markets, what we're seeing now is...
We're seeing it.
Yeah. Terrific. No, that's very helpful, Sanjeev. By the way, I think...
One more thing. Yeah. You see, as entrepreneurs, as young entrepreneurs, we are charged up with opportunity and upside and valuation and growth. But if you really want to last, it's not just about identifying opportunity and return. It's also about managing risk. Because over a 30, 40-year time horizon, company will face many, many existential threats and risks. So how well you anticipate risk, how well you dissect that risk, understand it, how well you mitigate it, how well you insulate your company from that risk, and all sorts of risks, right? That will determine your survival. So we only look at return. We don't study risk enough. As entrepreneurs, we are not, but a great entrepreneur who will build a company and last will also study risk and understand it.
Yeah. And do you all spend a lot of time, Sanjeev, at InfoEdge and also maybe in the other companies where you're on boards, actually on this point about risk, really trying to understand?
One of the first things, you ask any of our investees, you say, Sanjeev is such a pessimist. He keeps talking about risk. He's a wet blanket, right? But I do believe that understanding risk is really important.
Yeah. And you're absolutely right, Sanjeev. I think a large number of our founders and startups around the world, but also in India, they don't really spend enough time on risk.
When you're 23 or 25 or 28, you haven't seen this. For me, this is I became an entrepreneur in 1990. This is the 6th or 7th slowdown / recession / meltdown that I have experienced.
Right.
And each one is different for different reasons.
Yeah.
Right. And with each one, you learn something new.
Yeah. No, absolutely. No, that's terrific. Thank you, Sanjeev. I love I was going to say this idea of a repeatable, profitable unit. It'll be great for, all the, every person in the audience in their respective companies to think about that, because I think it's a very, very powerful idea. And Sanjeev, you mentioned this, several times, which is if you can find that repeatable, profitable unit, in your company, I think that really helps you scale. So Sanjeev, in the audience today, we have both sort of early stage companies, startups, but also we have actually very established companies that are in traditional industries like banking and consumer products and so on and so forth, right? So I want to maybe focus, we'll focus on across the spectrum, but maybe focus on the very early stage companies that are in the audience. As an early stage company, Sanjay, so you talked about, your perspectives on what it takes to build an enduring company, and those are incredibly invaluable. But as an early stage company, what are those 2 or 3 things that really matter to make sure that you get the ability to just get to the next stage?
So I think, first of all, does the customer want what you're selling and what you're making? Now, if the customer doesn't want it and you have to push it, right? There's a challenge. You can push it to a certain extent. You can, power your growth through marketing and advertising, right? But if the customer doesn't fundamentally want it, there will be a limit to your growth. If there's a limit to your growth, there will be a limit to your profit. Maybe you won't get to profit, right? So, does the customer need and want what you're selling? That's the first thing. And what I like to tell people, and what I believe, is that successful businesses are built on deep customer insights. So I'll repeat that. Successful businesses are built on deep customer insights. Deep customer insights about what? About their needs, their wants, their unsatisfied, their unsolved problems. So if you can identify the unsolved problem of the customer and solve it, right, you won't have to sell, the customer will buy. And if you're in a situation where the customer is buying without you trying to sell, right, you will grow. You will make a profit. You'll get the price you want. You get the terms of trade. You get 100% advance. Naukri still charges 100% advance, and we get it.
You still charge 100% advance, no credit?
Yes, no credit.
That's insane.
So we are sitting on, I think, 600 to 700 crores, 600 crores in the last check of customer advances at this point in time.
That's incredible. So no credit.
No.
Naukri doesn't give credit. My gosh, B2B business that doesn't give credit. All B2B companies in the audience, please note.
So listen, the point is, if you make a product which is so good that the customers will be advanced for it, that is the acid test.
Yeah.
And I learned this very early. I began my career in advertising straight out of college in Lintas in Delhi. And, I used to get, every Monday morning, there'd be a meeting with the branch manager and all the client servicing guys, and we get flogged because there were so many outstandings. Clients wouldn't pay.
They haven't paid on time.
Okay. And, getting, in the mid 80s, Delhi was not this city. It was not full of multinationals and all of that. It was, a bunch of companies which would not pay, right? And I used to go out and beg and plead. Half my time was spending in accounts department for client company. Boss, please give the check. And I made up my mind. I will never ever do a business where I have to, chase money, right? I will never give credit, and that has stayed with us. Yeah. So just build such a great product. Build such a great product that people pay you in advance.
Yeah.
And that's what I learned.
That's a simple, model. So does that mean, Sanjeev, that you're not a big fan of, like we have so many different kinds of business models in startup land, as you know. We have freemium businesses. What that means is you give it away for free and hope that someday you will make money somehow. You have no idea how it's going to happen.
So Jeevan Sathi is like that.
Yeah.
Other business is like that. Okay. But, so what I'll tell you, there are kinds and kinds of models. We have invested in several, and we have invested in several which are doing that, and they're giving credit or they're freemium or whatever, right? And some of them are burning a lot of capital. I know, although we didn't. We invest in many things. Yeah. Okay, but I'll tell you something. We have invested in more than 50 startups. We have done about 10 or 12 businesses of our own, and still doing them. But here's a little thing that you must know. Only one of them makes a profit, and that's Naukri.
Right.
So out of 50 or 60 businesses, okay.
Now, others get businesses, one of them makes profit. That's very interesting.
Yeah, and that is what has fueled everything. Naukri.
Yeah, you need to have one, and I think this is also important, right, Sanjeev? And I learned this, when I was at Google for a long time, which is you need to be an enduring company. You obviously over time will be multi-product. All companies are. Some become multi-industry, but you need to have at least one extraordinary cash generating engine.
Exactly. You need a cash engine. So there were people in the classified space who diversified into other classified spaces the way we did after we did it, but none of them had a cash cow. And Naukri is not a cash cow. It's growing like a star, but it's highly cash accretive. So you need cash coming in from somewhere before you diversify.
Yeah. I think it's such an important point, Sanjeev, because Google's entire engine is just still driven by search. It is an insanely profitable business that enables Google to invest in all these other superbly interesting businesses. So I think, Sanjeev, when you said, look, do customers really want what you're building? You're talking about product market fit, right? So essentially what you're saying is, look, really figure out as an early stage company, have you built something that your customers really want? And ideally, to Sanjeev's point, are they willing to pay for it? And I think it's an interesting question.
And are they willing to pay a price that's higher than your cost? That is really important.
By the way, 2022, Sanjeev, unlike 2021, negative gross margins are not acceptable anymore. In fact, now we are in positive CM2 territory. If your margin 2 is not positive.
That's exactly the point. The markets can turn. And therefore, as a company, if you had not anticipated the market turn and you're not built against it, right? Suddenly you have to pivot in 6 months to, positive gross margin and significantly positive gross margin and somehow still grow and managing the cash you have, and maybe you can get some little bit more. If you are not able to do that, you will be in trouble. How will you last? So financial strength, operating profit is a very big ingredient of lasting.
Yeah, no, absolutely. I mean, I think that's a very important message to everybody in the audience, right? Look, if you are not going to get to a point where you're going to generate free cash flow, you're never going to be enduring, because at some point, living on borrowed money or living on other people's money, OPM, pretty much leads to only one outcome, which is the end. Okay, so Sanjeev, let's talk about building capital efficiently. I always tell our founders in our Sequoia Surge program your story and the InfoEdge story of you raised 1.7 million of venture capital funding, and then you had 1.4 million of that when you went public. Is that right? Did I get the math right?
No. So see, we raised 7.3 crores. That's over 1.7 million, right? At that time, the dollar was 40 rupees.
At the time.
Yeah. We used about 5 crores. We had 2 crores left in the bank when we broke even. Once we broke even, we kept making money every month, and the cash balance kept going up.
Got it.
Right?
So there you go, right? You heard it from Sanjeev. So I think obviously, and so all the venture capital you raised was $1.7 million at the time, which is today, by the way, like less than a seed round, which is crazy. And you actually took the company public. So maybe talk a little bit about, Sanjeev, like what does it take to build capital efficiently? I mean, obviously one is if your customers are paying you for it and they're paying you in advance, that helps a lot. But what else does it take to really build? Because today, as you know, we have so many companies in the Indian ecosystem, in Southeast Asia, now beginning in MENA, right? That not just burn a few $1 million a year. Some of them are burning hundreds of millions of dollars a year, right? So what does it take to build a capital efficient business?
So you will never build a capital efficient business unless capital is scarce. If capital is abundant, right, then you will just spend it, right? And you won't work hard enough to see how to do more for less.
Yeah.
Right? Now, I don't blame companies, because if that's in the environment, and if they don't raise capital, their competition will.
Yeah.
Right? And if competition raises it, you got to raise it. Right? But here's the thing, right? So one is there has to be less capital. If there's less capital, you make it work harder.
So 2022 in that context will help the ecosystem. There'll be less capital.
Okay. Now, but that apart, you see, you got to focus on building IP.
Yeah.
Now, IP means brand, it means database, it means analytics, it means superior intelligence, it means algorithms, it means all those things. It means a network effect. So you build IP leading to a network effect. You build IP leading to switching costs, that you get into a customer, the guy can't switch. So the holy grail, according to me, are two. You build IP first, that's the foundation. On the basis of that IP, you either get a network effect, okay, but eventually there should be a switching cost. Okay, so let's say you're a B2B SaaS company and you get into a company and you kind of integrate with the internal systems. They start using you, right? if it's going to be a pain to switch to your competition, there'll be too much integration. How do I get out of this? My people are used to it, right? There's a switching cost. You will get annuity revenues. You can raise prices slowly every year. The more and more people you will build something that lasts, right? And okay. The other is if there's a network effect, and the two are not dislocated. You could have both together simultaneously, right? Now, let me tell you about the network effect and Naukri, right? So very early on, 7 years before we launched Naukri, I realized that jobs are a high interest category of information. Like customer insight, I used to observe my colleagues look at the appointment ads in magazines and not read the articles.
Right.
And I said, man, this is weird behavior. They are in a multinational. They're not going to switch their jobs. They're being paid well, great brands. It's a good logo on the visiting card, that multinational corporation. Why are they looking at jobs? But they would look at jobs. And that's when I realized that, listen, people look at jobs all the time, even if they don't apply for one. They want to know what's happening in the market. And so when we launched Naukri, I said, look, if we can just get all the jobs that are printed, published anywhere onto the site, we'll get traffic. And that's what happened. We got 29 newspapers around the country and put the jobs up every week.
Right.
And we keep it live for a month. And traffic came. So now a virtuous circle developed. We've got the most jobs. Therefore, we get the most traffic. We get the most traffic. Therefore, we get the most response.
Right.
We get the most response. Therefore, we get the most clients. We get the most clients. Therefore, we get the most jobs. So it snowballs. That is our network effect. Now, on the foundation of that, we were able to charge prices. We were able to make money. We were able to build a resume database. That resume database, again, became a very valuable asset. So now we've got a brand name Naukri and a URL. We've got the most jobs, a job database. We've now got the most resumes. We've got the most footfall. We've got the most from the recruiter side, recruitment side, on the employee side. So the whole thing is now working together. Because we make the most money, we are able to now invest in data analytics, in AI/ML, in that team. It's expensive stuff. Okay. Now, all of this has taken 25 years.
Right.
Okay. So 10 years ago, we weren't doing this kind of data analytics or this kind of AI. Right. And you can do it if you're making money or you're raising lots of money.
Right.
We were making money.
Right.
Now, all of this, hopefully, as we have evolved. Now, I'll tell you one growth hack we did. So in the beginning, all the ideas were mine, right? From 97 to 2000. Okay. Then Hitesh joined. The sales idea was his.
Right.
Now we had 200 salespeople in the market. I started a Yahoo group. In those days, there was no WhatsApp. There was Yahoo group, email. Of all the sales guys and the engineers, the product marketing, the top management. One Yahoo group. Okay. And we just told the sales guys, when you make 3-4 sales calls a day, whatever your client tells you, just put it down here and send it out. End of the day. So we had begun to get customer feedback within 24 hours to the top management and to everybody, every customer. Okay. And if we found the customer saying, hey, this is not working well, improve this here. Hey, add this feature. And we found that made sense or enough people said it, we do it.
Yeah.
So from 2000 to 2004 or 5, we were simply listening to the customer and doing what the customer wanted. Right? You listen to the customer, do what the customer wants, he will buy your product again and again. It's very simple. It was a simple Yahoo group and the practice of giving feedback for the sales guys. We grew, we were profitable, we lasted.
Amazing. I think hopefully the audience is getting a sense of, if there's one thing about, I think Sanjeev, every time he speaks and you look at InfoEdge, is this extraordinary customer obsession, right? Really, really trying to understand your customers. What are their needs? What are their pain points? Build something that's very useful. And then over time, if you do that really well and you keep on it, you become very successful. Sanjeev, I want to move to a topic that has been, top of mind for lots of companies, especially in startup land over the last couple of months. Building an enduring company requires world-class governance. There's no two ways about it.
Yes.
And recently, we've had several examples of bad governance, right? From fraud to inflating numbers and many others. Now, you have very strong views on this topic. You had, I think tweeted about this even a couple of days ago. Talk to us about how you think about governance, Sanjeev, and both, companies that are very early stage, but also we have companies that are very well established and late stage. Tell us about governance. I mean, you have very strong views on this.
So listen, what I said in that tweet, first I said, look, corporate governance begins inside the founders, and founder is apostrophe S, S apostrophe, which is plural, right? Heads. If fundamentally you don't want it or are not committed to it, it won't happen. You can get all the directors, you can get the audit committees, you can get the auditors. But look, you're the guy who's there 24/7. And so if that's not in your head, it won't happen. Now, there's a old Indian way of doing business, right? So I tell you, I became an entrepreneur in 1990, right? And my father had been in the government, doctor in the government, honest government servant. If you're an honest government servant, there is no money, or there was no money, right? And I said I will not be dishonest, and and therefore I'll not join the government. So I'll join the private sector. So I went into the private sector, did my MBA, came back, became an entrepreneur, right? Now, around 94, for the first 7 years, 90 to 97, we drifted into a whole lot of small stuff, right?
Yeah.
I mean, everything that came our way just to survive. So one day I was called for a meeting from a guy who'd been a batch junior in IMA. He was working in a company in Delhi. And he said, listen, I have this market research assignment. Will you do it? I said, sure, we'll do it. Anything, So fine, give me a proposal. So we made a proposal and we proposed 40,000 rupees. And the guy says, okay, fine, now make it 80,000 rupees and we'll split the difference. Right? And I was a little shocked. So I said, I'll come back to you. Right? And I went back, from that meeting, and it was tempting, right? 60,000 bucks. I mean, 20,000 for him, 60,000 for us. It was tempting. And I did a lot of soul searching. And I said, look, I didn't become an entrepreneur for this. And I said no. I said no to the assignment. And, and until I was tested on that day, or those 3-4 days where I thought about it, right? The switch didn't flip in my head that this is now religion. So from that day onwards, it became religion for me. Right? Until then, I was honest, but I had not thought about it. I was honest in my DNA.
Situation.
But this time I was confronted with a choice.
Yeah.
And I said, you know what? I didn't come here to be like this. Right? And so by the time ICICI came on board, we were already honest.
Right.
No, we didn't have independent directors. We didn't have a big 5 auditor. We didn't have all of that. But we were clean. We were squeaky clean. Right? So when ICICI came on board, they told us 3-4 things. Listen, understand now, it's not your company alone. It's also our company. So these agreements are fine, but fundamentally you got it in your head that, look, you have to treat minority shareholders well. We are a minority shareholder. You got to treat us well. We're giving you our money. 2, we are betting our money. You're betting your life. Right now we have a portfolio of companies. So, but you only have one life. You're betting it. You can't do 2 things, 3 things, 4 things. You're only doing this. And you're doing it until you succeed. Number 3, you can't make money till we make money. So we set your salary. And you can't make money on our money. You make money. You make our money work to make money for everybody, including us and you. So alignment of interest. So, those sort of things happen. Now, they insisted on a big 5 auditor. And I said, listen, we can't afford one. We are clean. No. We want a big 5 auditor. So I went shopping. I spoke to all the big 5. Somebody go to 10 lakhs, somebody go to 5 lakhs. I said, are you crazy? Our last year profit was 1.8 lakhs. I'm going to, there's no way I'm spending 10 lakhs on an audit. So finally, I ran into Kaushik Datta, who's a partner at Pricewaterhouse then. And he said, look, what do you want? I said, I'm willing to pay half of last year's profit for my audit fees this year. So I'll give you 1 lakh rupees. I want to audit in 1 lakh. So he thought for about 3.5 seconds. And he said, okay, fine. I'll do it in 1 lakh if you promise me two things. So I said, yeah, sure, what? He says, first of all, you will be squeaky clean. So you can't make me work hard for 1 lakh. I shouldn't have to second guess you. Whether you lying, making the truth. Right? I've got to believe you and trust you. So you promised me that you will not lie. I say, yeah, we don't lie. We're clean. So, okay. Second, you got to understand and internalize that your independent directors, whenever you have them, and your auditors are there to save you from yourself. We are not your enemies. We're not policemen. We are on your side. But accept that you will make mistakes if we don't stop you. So we are here to save you from yourself. I said, I accept that. I will not, if you're uncomfortable, I won't do something. Now the relationship evolved to a point that, and the third thing he said was that I'll raise my fees next year. You got to accept that. Right? I'll do it in 1 lakh only the first year. Right? I said, okay.
As your profits grow, he'll raise his fees. So that.
Yes. Till I reach my normal fees.
Right.
Okay. Right. So I said yes to all three. Right? Now the relationship evolved to a point where every time we are confronted with a choice, see, in accounting, in revenue recognition, in amortization of costs, there are several judgmental decisions, several gray areas. You can go this way or that way. We would simply call up Kaushik and say, Acha, listen, there's this thing. You can do this way or that way. You want to do this way? Are you okay with that? He said, no, I'm not okay with that. And we just do the other way, what he said. Right? So what happened to us is that our accounts were, in effect, pre-audited.
Yeah.
Because we would call him up every week, 2 weeks, whenever there was a gray area, and said, we're looking at this, what do you think? And he would tell us, no, this is not okay, do it this way. So he became not just an auditor, he would tell us beforehand. Right? And that's how we were governed.
Yeah. No, absolutely. Thank you, Sanjeev, and thank you for being a torchbearer for good governance and corporate governance in the ecosystem. Sanjeev, I know we are at time, so I'll go to the last question. Obviously, 2021 was a remarkable year for the Indian startup ecosystem. We had over 40 new unicorns, over $40 billion of funding. We had many IPOs, including several companies where you're, Infosys is an investor in, Zomato, PolicyBazaar, etc. But we also saw what happens when, on this journey to enduring or the journey to build to last, which is you go from being a private company to being a public company, right? And we've learned that some of our companies that have gone from private to public, have really not transitioned possibly as well. Now we realize it's all very early, and all public tech stocks are down between 40 and 70% even in the US. So it's gonna obviously happen here too. But the last question I want to ask you, Sanjeev, is what is the difference between being a public company and a private company? And as companies sort of continue to build towards build to last, eventually you have to be public. Not everything has to be like Zerodha. Nitin will probably stay private forever. But as you become, if you are going to go public or you're a public company, just tell us a little bit about what's the difference and what does it take to be a successful public company?
So first of all, if you've raised external capital in the form of equity, right, where you have VCs do want an exit at some point in time, you're going to give that exit. Right? Now, there are three sources of exits. There is a strategic sale. Well, there are four. There's a secondary sale to roll it over another investor. Third is go public. Fourth is company buyback. Company buybacks will never, ever give the investors the kind of return they're looking for. You will not be able to afford it because they want 10x, 20x, 30x. Right? You won't have the cash. You can't do it. If you roll over to another investor, right, that new investor will want to exit sometime. And it'll probably late-stage investor will want exit in 2, 3, 4 years. Late-stage investors want exits early, right?
Yeah.
Which leaves a strategic sale. Now, if you want to run an independent institution and build it to last, right? Then you won't want a strategic sale necessarily, right? Then going public remains the only option. And therefore, it's a logical choice for many people. Not everybody, many people. So first of all, you should not go public until your company is ready to go public. Now, what do I mean by readiness? It means certain size, certain scale, certain growth still left. If not profitable, at least visibility of some profit 2-3 years later. Because it's in a rare situation that public market investors will tolerate 10 years of a loss-making company. right? There has to be fundamentally in public markets, in the long run, you will be priced of an earnings multiple. So if you can understand that fundamental truth, for there to be a PE, there has to be an E.
That's right. There's no PE without an E.
Right? So if not now, 2-3 years, visibility, path to profit, unit economics, margin, and there should be some growth left. So minimum size and scale, unit economics, so when you're ready to go public, then now that's the first thing. The second is you have to have a management team to go public. Depth and width of management. So when we went public in 2006, I remained CEO till 2010, but de facto, Hitesh had taken over most of the responsibilities after we went public. It took us a year and a half to go public, and I had more or less removed myself. We had to hire a whole second layer in finance, right? Because again, Amrish, as the CFO then, had to take a lot of time to go public. So it demands attention. It demands management bandwidth. It demanded an overhaul of our internal systems and processes, right? So it took us 15 months to get those things in order. Now, like a good homegrown company, bootstrapping, cutting cost, right? We had built our own ERP internally for our own use.
Oh, wow.
Okay. Now, it was all very well till we began to go public. And then Pricewaterhouse said, oh my God, we don't know what's inside this ERP because, you can tweak anything. It's not a standard product. There's no manual. There's no third party. You're doing it yourself. Right? So for example, we sell a subscription, right? So it's 12-month subscription. Right. We recognize revenue over life of subscription. If we own and control the ERP and it's a black box, if we were dishonest, we could say, hey, load the revenue higher in this quarter rather than that quarter.
Right.
They won't know. The auditors won't know.
True.
So they signed off on the IPO thing, saying that within 12 months of going public, you will migrate to a standard ERP system. We had to do that. We moved to Microsoft Navision, right? Within 12 months of the IPO. So there are many, many things that go into making a company ready for public. And then there is investor relations, and then there's a sales job. So investor relation is a sales and service job. It's not a finance job.
Right.
Let's be clear about that. Then there's a scrutiny. Then there's a humility. And listen, anybody can ask any question. Okay? You got to answer it with the same patience for everyone. Then there is understanding that the governance norms and levels are different. Right? You cannot tell somebody something and not tell everybody else. If that person on that basis buys your stock, you're in trouble.
Yeah.
The willingness to make yourself available to investors or even prospective investors who want to talk to you. All of that becomes really important. So if you go public and you're the CEO, you can more or less forget about building product yourself.
Yeah.
Okay, that phase of life is over.
Right.
Or you hire a CEO who does that.
Right.
But then if you hire a CEO, then you got to give away half your powers.
Right. Terrific. Thank you, Sanjeev. I think on that note, greatly appreciate your joining us, Sanjeev, and for all your thoughts. And I think for most importantly, for being a flag bearer for building enduring companies that last. I hope everybody in the room, be they CMOs, CEOs, either early stage companies, very well established companies, hopefully all will focus on the right things to build to last. And keep in mind that building to last is very difficult. As Sanjeev said, it's a lifetime of work, and it does require many things to come together. But hopefully we'll go as an ecosystem, we'll go from strength to strength, and 10 years from now, we'll be in a whole different place. Thank you, Sanjeev.
Hey, thank you so much. Thank you for inviting me, and bye-bye, everyone.
Bye.